I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
Equity markets, a little bit of a dip, and then back up, charging along again. We keep having these little scares. Should we be scared?
Well, yes and no. We do have some cracks in the foundation. We do have a Dow theory non-confirmation. We do have a few things, some technical hurdles here that have not been crossed, if you will, with the latest new high earlier in August. And, can you say positively that the bubble has popped yet? Well, obviously not. But I think that equities have run into trouble. They're at an extremely important juncture. When I look at certain markets, certain indexes, I see evidence of, what I term the seasonal cycle top, which is a top of a cycle of about a year in duration. And when I look at other indexes, for example, the Tel Aviv 35, it actually looks like we've seen a 4-year cycle top there. And so, yes, we're at an important juncture in equity. So from that perspective, there is reason for concern. But can we say, technically, have we seen, the I's dotted and the T's crossed on this top? No, not yet. No, we haven't.
Do you find it incredible? We're into what, year 8, year 9 of the 4-year cycle?
Well, no, we had the 4-year cycle in 2016. It extended into 2016, but I find it incredible that the bubble, the overall advance, out of the 2009 low has extended to the degree that it has, that the last 4-year cycle stretched like it did, and that it continued with this one. And we've talked about, I know it's old, it's been a while since we've talked about it, but it hasn't changed. We talked about the volume characteristics of the market going into this top, and they continue to dwindle. Looking at the volume on the Dow specifically, in the S&P, some people have taken me to task on that, and they say, well, you can explain it this way or that way or another, but no, you really can't. And then if you look at key stocks, you see the same thing. If you look at the volume characteristics on Apple, or I don't remember, I was going through charts the other day. I think maybe Northrop Grumman is a good example of that too. But there's any number of stocks where you see that this entire advance has occurred on decreasing volume. So there's no question in my mind, like I said, that it is an extended bubble, and there's no question in my mind how extended bubbles end. It's just that we must see the proper setup to cap it. And it tried in 2016 or 15, and then with the decline in 2016, and, hey, it didn't happen. And so now, waiting on the next setup, which, like I said, we have cracks in the foundation.
When you're looking for particular cracks, can you identify them, or is it a kind of a giant overview?
No, there's specific cracks you can identify. And, when I say cracks, it's the DNA markers. Okay, number one, do we have a Dow theory non-confirmation? Yes, boom, okay. The next thing, what is it going to take to solidify that Dow theory non-confirmation? We need to see a Dow theory primary bearish trend change. Have we seen that? Nope, we can't X that one off the list. It's my intermediate term advanced decline line non-confirmation. That's one of the DNA markers. And like I've talked about before, each one of the intermediate term advances coming out of the 2016 4-year cycle low has occurred with diminishing, if you will, intermediate term internals. When you compare, if you just look at a cumulative AD line or the cumulative data, you don't see it because it's cumulative. But what I do is I compare the intermediate term internals of one cycle to the internals of the next cycle, and you can see how it's been each advance in price has been with diminishing internals, intermediate term internals. So yes, that one is in place. So yes, there's cracks, but again, until we get the Dow theory primary bearish trend change, you can't really say that it's done. Now, the fact that we do have some of these things in place obviously makes it more risky than 2 months ago when we didn't have anything in place. So yes, it's reason for concern.
We'll have more with Tim Wood right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Wood. Tim, commodities, how are they tied to the equity markets?
Well, that is a key thing, and I have been talking in my letter, or writing in my letter, I should say, all year that, is it 1927 or is it 1929? And what I have been, the spirit of that is that are we nearing a top, pushing into a top, or do we have further to go? Is the bubble going to continue to extend? And I think commodities are the canary in the coal mine. And I've said that. I think the behavior, the structural behavior with the CRB and some of the components are very, very important. And if we see a structural solidification, if you will, of some cycle tops in commodities, then I think equities and everything else is going to follow. I think that will tell us that it's just a deflationary collapse, which is what I ultimately expect. And then if you look at some of the markets, like, looking at wheat, wheat is back to January of 17 levels. It's broken down hard, reversed hard this last month. If you look at like soybeans, we're back to October of 16 levels with soybeans. Now, we do have a lower low in June of this year, so there is some short-term positive structure there, but longer term it looks like, the soybeans are in trouble. Looking at corn, they're back to December 16 levels. And so we're looking at, underneath the hood, if you will, of the components of the CRB, we're seeing some issues there. But on the other hand, if you look at metals, they've held up a little better than expected. Now, I still think, based on the statistics, based on the cycles, based on the fact that the 2015 low was only 7 years into the 9-year cycle, based on, the statistics with the annual cycles, that's embedded within that 9-year cycle, nothing's broken yet. While what I'm saying is nothing's broken with it to change the expectation that the 9-year cycle low is still ahead. At the same time, it's intermediate term advance. We had an intermediate term buy signal, so that was no surprise. But the advance is a little stronger than expected. But we're still working within the confines of the statistics and the overall expectation. Now, should something change with that, then at that time, hey, I got to go with it. It's not going to make sense in that we still have, like I said, the the 9-year, or what would be then possibly a 9-year cycle low in only 7 years. I mean, that doesn't compute. That's never happened. But should that be forced upon us, then I guess we have to go with it. But until it's forced upon us with some statistics and some structure, then the previous expectation has to stand.
We'll have more with Tim Cyclesman Wood right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're talking with Tim Cyclesman Wood. Tim, where does gold fit into what's happening right now?
Let me add one more thing with gold. Gold may be sensing something. Gold may be sensing that something is not right with equities, but with commodities and equities, commodities and specifically are at a very, very, very important technical juncture here. And I'm going to show some stuff and working on some studies. I'm going to show in the September letter, which will be out next weekend, showing the correlation between equities and what I'm looking at, the 27 versus the 29 scenario. And the jury's still out on it. I mean, we've been monitoring this, and so far it's leaning one way, but like I said, the jury's still out. And we're at that, basically the last technical juncture here where it's going to go one way or the other. And so I don't know which way it's going to swing. I'm going to lay it out to look at and let it be what it's going to be. I mean, it's not like we can change it. We just have to follow it. But my thinking is that the advance in gold has, like I said, it's been a little stronger than expected, but nothing has changed that longer term expectation yet. And so, I think that, gold is, at this point, my thinking is that it does turn down into the 9-year cycle low like we've been thinking. In the meantime, hey, we had an intermediate term buy signal. It's still in place.
Oil. Is it going to continue to churn where it is right now, where it only goes up or down a dollar or two, or could we see a real downturn just on seasonality?
Well, seasonality alone, we should be in the weak period, and we do have an intermediate term sell signal on oil. And I do think that oil is ultimately headed lower. We've been saying that. And being commodities, I mean, look at it. Oil has been weak and down. The grains, weak and down. The CRB complex in and of itself has been weak, very, very weak. Like I said, the cyclical structure is not all the way broken yet, but it's wounded severely. All right? We're waiting on it to take its last breath or recuperate, whichever it's going to be. And so the metals are the anomaly here. And like I said, it's about to show itself one way or the other, and the expectation is it turns down. Anyway, with oil, no, I still think oil is probably headed lower. That's the expectation, and like I said, nothing's changed.
Consumer confidence is at its highest level since 2007. And I remember reading a story around that time about consumer confidence is at a record high. And then right after that, we had the big crash. Is that kind of a warning sign when consumer confidence hits record highs again, that something is about to happen and it's not going to be good? Yeah, I mean, it's not a timing tool, but those sort of things are definitely, they tend to tell you which way the wind's blowing if you know how to, the signs of reading them. It reminds me of the book, Oh Yeah. I don't know if anyone's familiar with that, but it tells all the quotes. It's kind of like the Janet Yellen comment. I don't remember what she said exactly, but something to the effect that, we're never going to have another downturn like that, or no chance of it, or whatever it was she said. And people always get the most bullish at the top and the most bearish
at the bottom, and that's just, you know, the nature. But I think that's just a sign of people being, I don't know what the word is, mesmerized by the advance. You know, I said that this was a very, very dangerous, extended move, and no one sees that. That's a sign that no one sees that. And people are going to be, look, I stand by my statement. I know that I've been saying this for a while. The problem is that, and it's not an excuse. I mean, I'm acknowledging it. The fact that it was a bubble a year ago or 2 years ago at the 15 top, it was extended. And we turned down into the 4-year cycle low. We didn't get much of a decline into the 4-year cycle low. But okay, that's fine. You know, no one can control that, or, you know, none of us can control that. But we had the intervention and the things that happened, and it extended the bubble. Does it change the fact that it's a bubble? I mean, it's kind of like having rust on the fender of your car, I guess, in a corny example. But you know, you can paint over the rust, but you didn't fix the rust. I mean, it's still a bubble, and so I stand by those statements. There's no question in my mind. This is a disaster, and I cannot control or help, and neither can anyone else, the fact that it is extended the way it has. But I'm not going to back up on my comments of what I see. And so until, like I said, once we get the setup, then yes, I think that obviously the opportunity then is going to be for it to come unraveled. And the problem with this is that people don't get it. They don't understand. And I've said this before too. The longer you're in an abnormal situation or you deal with abnormal, the more normal it becomes. It's adopted. You know, you adapt and you accept it as normal. It's like oil prices. When oil prices were so high, I made the same comment. I said, this isn't normal. People accepted that as normal with $100+ oil. And I'm like, no, this isn't normal. And you probably remember I think you and I were doing interviews then, and I did the study and I showed where oil prices were going. It took a little while for it to get there, but the math, it came back to the norm. And the same thing is going to happen here. And so the danger with comments like that is that people don't understand. They just don't understand. And they think that they're not exposed to it because maybe they don't directly have money in the market, but we are all exposed to the collapsing of this bubble when it happens.
Janet Yellen, the head of the Fed, said we shouldn't really expect an economic disaster or downturn within our lifetime. I've just looked it up. She's 70.
That's the comment. Yeah, that's what I was referring to.
Right. She's 71 years old. The U.S. life expectancy is 78.74 years. It's actually gone down a little bit because of poverty. But, and she's not a poor person, so we can expect her to live probably for another 7 years. Is that really, when you say within our lifetime, a really smart thing to say at her age?
I don't know how this could possibly extend that long. I just don't see it. I mean, I didn't think it would extend to the extent that it has, obviously, but to get another 7 years out of this insanity, I just don't see it. And the thing that scares me about this bubble, this is way different than 2009. I've said that I think that it's going to be far worse than the collapse into 2009. But the thing that scares me, and one of the reasons I say that, is that in 2009, hey, it was just it was a housing bubble, and there was a commodity bubble, and there was I wouldn't even go so far as to say it was a bubble. It was a manufactured liquidity driven advance in equities. I wouldn't even classify that part of it as a bubble, but it was financial. It was contained, if you will. This time, personally, I see it a little different. I think that there are other factors when you look at the current economic, just not just the economics of it, the financial side of it, but when you look at the social side of it, when you look at the political side of it, this could be vastly different than 2009.
Well, we were told 2009 was the worst recession since the dirty 30s. How bad will the next one be?
You know, who knows? But I think it's going to be every bit as bad as the that of the 30s. And like I said, the thing that concerns me is that by every measure, any technician that's been around, any of the old guys, you know, you talk to Peter Elides, any of the great technicians, they see it for what it is. And, you know, like I said, I stand by those statements. So, you know, the volume characteristics tell us that. You look at some of the basic underlying characteristics of the economy, like I said, with the velocity of money and job participation. We've talked about those things. They haven't improved. I mean, it is a fabricated advance. And then you throw the social stuff that we see going on, the political, I don't know what title you want to put on that, but controversy or disdain or whatever word you want to put on the political goings on in this country. I mean, who knows? It could get very, very interesting when the bubble bursts.
Tim, where should people be putting their assets right now if they don't want to be caught up in this?
You know, I just wouldn't want any exposure to the market, to equities. I would not. I just simply would not want any exposure to equities. I don't think it's time for the gold trade yet. I know that there's a lot of people looking for the big move in gold, and me included. I mean, I'm very bullish on gold once we get this, you know, confirmation that this 9-year cycle low is in. And here's the problem. It's real simple, guys. Listen. Ever since gold has been freely traded, and even before that, it took on the cycle of copper, and there's this 9-year cycle. And if it's always been that way, and you've always seen this 9-year cycle, and it's been, you know, somewhere around between 8 and some change and 9 and some change years, and it's always had 9 of these cycles in it, and then all of a sudden you got one that's only got 7. Are you willing to take that chance of going into that market until we can prove that we've seen something different? And when I say prove that we've seen something different, we need structure to prove it. And this next seasonal cycle down, which we're looking at later this year, possibly early next year, but probably I'm thinking November, December this year, that cycle down should prove it one way or the other. If it proves that we've seen the 9-year cycle low, then great. Now we have a green light and something we can go on, a comfort level. You can say, hey, this tells us that something is different. At this time, it doesn't tell us that anything is different, and so I would hate to say people that getting too excited too soon with gold move into it and then get crushed because that cycle down hasn't occurred and the statistic is fulfilled. So that's the risk. And so I don't think until we get past that hurdle that personally I don't like metals yet. We need that confirmation. Equities are risky. To me, your money in the bank or under your mattress or wherever you want to put it is a much better place to be at this point.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com Radio. Our YouTube channel is Talk Digital Network. Find us on Twitter at Talk Digital Net. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.